Welcome to the Quarter 2 Global and Domestic Market Commentary. If we start off with the international market commentary for Q2 2019, we can note the following. As financial markets crossed the midway point of 2019, except for the pullback in May, investors can reflect on a very positive second quarter and an even better first half. Most asset classes, regions, sectors and styles delivered strong gains over the period. Focusing on the second quarter, economic data generally came through softer than expected, which prompted leading economists to downgrade forecasts for global growth in 2019. Company analysts also moderated their expectations for corporate earnings, whilst the breakdown of US-China trade talks and the threat of increased tariffs were regular market headlines. Investors remained positive through April, but by the middle of May they started to focus more on the negative news flow, which led to a sharp drawdown as risky assets were sold off in favor of the safe haven asset classes. However, in early June, the central bank stepped in and the clouds were lifted. The key turning point was a speech by Federal Reserve Chairman Powell in which he effectively endorsed expectations that US interest rates would be cut in the second half of 2019. With the shift in stance on interest rates confirmed, investor confidence was restored and markets started going upwards again. Over the second quarter, global equities advanced by 3.8% when measured using the MSCI All-Country World Index in US dollar terms. The vast majority of markets rose, with Europe ex the UK up 5.8%, the US was up 4.1%, leading the major markets, whilst Asia ex-Japan was all flat, down negative 0.7 for the quarter. The best sector returns tended to be amongst the cyclicals, with financials up 6%, IT up 5.3%, and industrials up 4.6%. The sharp downward adjustment in interest rate expectations underpinned strong performance across the fixed income market. The JP Morgan Global Government Bond Index was up 3.1% for the quarter, whilst investment-grade corporate bond index gained 3.8% and the high-yield index was up 2.8%. With the Federal Reserve's shift in policy stance reducing interest rate support, the US dollar declined against most currencies. Over the quarter, it weakened by 1.4% versus the euro, 2.7% against the yen, 1.9% relative to the dollar, Canadian dollar, and 2.2% versus the South African rand. However, whilst the dollar was under pressure, it wasn't at the bottom of the pack, as the pound was down 2.6% relative to the dollar and the Chinese yuan down 2.3%, weakened more due to uncertainties related to the Brexit and the US-China trade war. If we turn our attention to the domestic market, we note that the South African equity market delivered a very strong quarter with the FTSE JSE All-Share Index up 4.9%. This has pushed domestic equities up over 12% year to date, a strong return to positive territory. The rally in commodity prices and resource stocks continued into the second quarter. It should be noted, however, that even though the quarter was nicely positive, it was more a tale of two halves, with May being an extremely poor month of large market drawdowns. There was a strong risk-off environment as trade wars and the Middle East tensions erupted, but this was then put on the back foot as both globally and domestically more accommodative central bank policy became the order of the day, with interest rates expected to be lower for longer. The much-anticipated State of the Nation or SONA address by President Ramaphosa focused on growth-enhancing initiatives, although many considered it light on detail on the most critical issues, in particular the Eskom restructure. The rand benefited less from SONA and more from improved sentiment towards emerging market currencies, as a truce of sorts between the US and China was struck during the G20 meeting during June 2019. Despite a poor GDP number and continued unease about Eskom, the currency has actually appreciated by around 3.4% against the US dollar during the quarter. South African nominal bonds price benign inflation and the likelihood of more accommodative monetary policy, ending the month of June up 2.2% and the quarter up 3.7%. The local bond yield curve remains steep as bond investors price for rate cuts on the short to medium term, while longer-dated bonds reflect concerns about the impact of its Eskom, support on the fiscus, and the potential for a downgrade from credit ratings agency Moody's. South African equities recovered some of the previous month's losses alongside international trends, with the FTSE All-Share Index up 4.8% in June. Resource counters had a strong month, with the Resources Index surging 10.3%, with support from platinum and gold miners. Gold mining companies benefited from a resurgence in the gold price as the allure of the metal increases in the face of declining market interest rates and heightened geopolitical risks. The rand ended the second quarter of the year stronger against the major currencies, at 14 Rand 10 to the dollar, 17 Rand 95 to the pound, and 16 Rand and 6 cents to the euro. This was largely due to an overall strengthening of emerging market currencies against the US dollar, as well as being backed up by a more risk-on investment climate.